Hey everybody, welcome to the Hump Day Market Update. I'm your host, Lee Seiler, also known as the Stock Doctor. Also in the house, we have Nikki Ward, which we call our Megalennial. We appreciate you joining us. And look, we're going to talk about all things the market. And we actually had a really, really good day today, Nick.
We did. I mean, the NASDAQ hit a fresh 2023 high.
Nice, but now,
yes.
But the NASDAQ has already pretty much been there.
It has been, but at least the Dow is above the 50-day moving average.
Well, that's all good. However, the Dow is barely up for the year.
Correct.
We're talking less than 1%. The S&P, while it may be up 8%, it is made up of the top 8 stocks.
Yeah, the breadth has not been very wide.
If you take the 8 stocks out of that, you're down for the year.
Yeah.
So,
those are the heavy hitters too.
Yeah, no,
the ones we can all name.
Yeah, where it's the FANG stocks, which is Facebook, Apple, Netflix, Google, and did I name them all? Oh, then you had Microsoft and Nvidia and Andrew. It's echoey, is what I hear. But so when you add those in there, they really haven't done that well.
They're the ones carrying the market.
They are definitely carrying the market. Let's talk about what S&P.
Yeah.
Let's talk about what happened today. The Dow Jones was up 408 points at 33,420. The S&P up 48. I'm going to share the screen with you so you see that. S&P up 48 at 4158. The NASDAQ up 1.28%, 157 at 12.5. The small cap stocks were up big today, up 237, 2% on the small cap stocks. So what we're going to do today, we're going to make it really simple because we're going to talk about why we do what we do on the investment side. Because, by the way, as you can see the scrolling number in the email down there, we do manage money for a living. And what we do, and I'm going to just show you a couple of things, and I'm going to go to, let me get here, and then we're going to talk about some of the stocks we like. We'll take some questions and things like that. So I want to share a screen with you because, let me go. First of all, people ask us all the time. Bear with me, I'm just trying to get that. Okay. People ask all the time why we like First Trust and use First Trust information. Well, number one is because they're usually right, Nikki. I mean, they were 2000, I will show you again so we know, 2022 economic forecasters of the year.
And think about 2022. Really the things that we were talking about over last year were all about the unseen worries, the things that we saw coming down the pike. I mean, it was not your typical year. So for them to be the number one as far as economic outlook and most accurate, that speaks volumes.
Yeah, and here's the thing. These guys, nobody is going to be 100% correct. We know this. It's a challenge. And the fact of the matter is these guys have 40 CFAs, MBAs working on their staff. So I think they're a little bit more equipped than we are to come up with some suggestions of what's going on in the markets.
Without a doubt. And I mean, I think that economics, broadly speaking, is not only a science, but it's also a bit of an art. It isn't just one or the other. So it's about taking the broad look, the macro look at all of the economic indicators and forming an opinion. And not everyone's going to be right, but they are more right than they are wrong.
And Brian Westbury, who's their main economist, the guy is unbelievable and very funny and very entertaining to listen to. However, he has been known as the permabull.
That's his moniker, but this year he's not. And so someone who has been this permabull for at least a decade, I think, safe to say.
Well, aside from a pandemic, he's pretty much right.
But even still, he was still bullish during the pandemic. This year is the first time personally that I've ever heard him give a bearish take.
All right, so let's.
And so that makes you pay attention.
What First Trust thinks is that they have an S&P target. This is their year-end target, 3,900, 33,000 Dow. We're above that. So they don't believe you have much upside here left in the market, if any at all.
We're above that. We've been in a tight trading range since the start of the year, though. I mean, we haven't been able to push past 4,200.
So the Fed, by the way, there is a lot going on, obviously, when it comes to interest rates. The Fed will meet again June 13th, 14th. The question is, will they raise rates? 1 out of 4 say they will not raise rates. They will not raise rates in June. And the balance thinks that there could be 3 to 4 rate cuts coming by year's end. And I think we've gone on record, and I'm going to speak for myself. You can speak for yourself. I know you do, Nikki. I'll speak for myself that I don't believe there's 3 or 4 rate cuts. I think there's 1. But maybe we get lucky. Your thoughts?
My thoughts are, I'm going to be really honest. Ready?
Honest. Tell me.
I don't give a shit what anyone in the Fed thinks right now because they've been so wrong so many times. What I care about is how can we make money in today's market and the market we see going forward for the next 6 months to a year. Because
Great point.
There are attractive areas in the market, and I'm not going to sit here and just obsess over what the Fed is doing because everybody is doing that, and it's not really that relevant.
We call her Negative Nick sometimes. So that's a good point because let's go to what one thing that concerns me is market valuation.
Mm-hmm.
And market valuation, it's not undervalued, it's not overvalued, but it really is fairly valued. Let me just show you here. When you look at, I'm going to watch my cursor, please. You'll see here the green line is a 22 PE. That is basically where the market is overvalued, and the average PE ratio, price to earnings, over the basically since 1996, we'll go back and see, it's about 18 times earnings, or an 18 PE, and here's this line is 14.43. So what you see is we're right about an average valuation. We're not too hot, we're not too cold, and to me that means what's it going to take for us to have more upside? And when you are in a market where they're concerned about earnings going forward, that may be a concern.
Yeah, I mean, Goldilocks, we started the year at 18 times, and multiples have increased on a combination of falling earnings and rising equity prices. That's not sustainable.
No, but there's always a place to make money. Jim Cramer, whom I know very well, was on my radio show in the past. He goes, there's always a place to make money, and there really is. So I'm going to share this with you because the growth component of the market, because in the S&P 500 is really 2 major components. There's growth and there's value. And there's a fine line sometimes between growth and value. But the fact of the matter is the growth segment is trading at 27 times earnings. The value segment is trading at 11.6 times earnings. So what that means is there is a huge segment of the stock market, and the S&P is 500 stocks.
Right.
And I guarantee you that more than half of those 500, probably 300, 350, 400 of those are trading at those low levels.
Right, because they're at a good value. So the average dispersion between growth and value sits between 6 to 8. Right now we're sitting at 16. So that means that there is plenty of room for you to find a good value at a discount.
And
it just isn't in the top 8 names. It isn't in the top handful.
Again, if you eliminate Apple, or if you eliminate Facebook, which is Meta.
I know, we need a new acronym.
Apple, Netflix, Google,
Nvidia,
Microsoft, and there's another
Amazon.
one. Amazon. You will have negative return for the year. So what does that tell us? I don't
put my eggs in that basket.
And here's what's interesting. I'm going to show you this because this to me is one of the most interesting charts you will ever see. I want you to go back to 2000.
Go back in the way back machine.
In the year 2000, the most valuable companies in the stock market by market cap, which is the most valuable, was Microsoft, GE, Cisco, Walmart, Intel, Lucent, etc., etc. Top 10.
How's Lucent doing these days?
Lucent's done, bankrupt. Cisco, not doing well. GE in the shitter. Walmart still okay. Intel okay, but not great. IBM okay, but not great. Citigroup, same thing. AOL merged. Okay, so let's compare the top companies in 2000 to the top companies in 2023. So before I go to you, Nick, I want to show you. We have how many common areas. We have Microsoft, which was number 1 in 2000, number 2 in 23. That's impressive. GE's done, Cisco no, Walmart no, Intel no, Lucent no. ExxonMobil
that's it.
is in there. That is it. You have 2 companies that were the most valuable, the top 10 companies in the world,
right,
from 2000 to now.
It just goes to show you shouldn't overweight the most popular things or the things that are doing well currently.
Things
because
change.
The market is a forward-looking indicator. So while we are in 2023, in February of 2023 is this, chart. I mean, the market is already looking at 6 months ahead of that, at least.
Let's take a step forward now. Go to 2010, because it's only 13 years. It's not much. So ExxonMobil, we know that was number 1 in 2010. We're still in there. You're number 8. Microsoft still in there. Walmart out. Alphabet in, Apple in, J&J, which is surprising, is not top 10.
That's not surprising because of all the shit they've been going through.
Procter & Gamble doesn't surprise me. IBM doesn't surprise me. AT&T, no. JP Morgan does surprise me a little bit.
That doesn't surprise me.
But, so you have 3. That's amazing to me. And take it to 2020, just 3 years ago.
Right.
You have...
Meta. Meta's not even in there anymore.
Meta's not in there. I thought it was.
That's striking.
Yeah. Meta, JP Morgan, J&J, and Walmart. So
even from 3 years ago.
6.
Yeah.
So that goes to tell you, folks, that things change. And what do you have to do? Well, you have to adjust your portfolios. You have to make sure that you're investing in things that will do well. And what this is telling me is you want to own things that will pay you to own them. And that's in the form of dividends, or as Mr. Wonderful, whom I'm a big fan of Shark Tank, is cash flow.
Cash money, baby.
Cash flow.
So the last 10 years, dividends have only averaged about 12% of the return for the S&P 500.
Yeah.
But historically, they're responsible for 40% of the return from the S&P 500.
And that's incredible, because if you look at this chart here from 1970, this is the S&P 500. The blue line is just the S&P 500 index.
Sans dividends.
Index. That's without dividends. When you add the dividends, look at that number. This is a growth of $10,000 in 1970. It gets you to about 400 and change. But with dividends, it gets you to $2 million. That is unbelievable.
Pretty insane. So these are the attractive areas of the market that we're really focusing on now that we're having this kind of return to the mean. I think the last 10, 12 years have been a bit of an anomaly. We've had, record low interest rates. We've been able to borrow at 0%. That's not normal.
And it's not there now.
And it's not going to be the new normal moving forward.
It's not there now. So if you're not sure about the market, but you still don't want to miss out, what do you do? This is what we're telling people. You call us for sure. You see the number there, 407-83. I'm waiting for it. 831-8002. It's there now.
Do you not know our phone number?
No, I was waiting for it to go there, and I was interpreting. So what you do is there are things we've been talking about, protection areas and things we can do to
These
protect.
are things that we're implementing into every single one of our clients'
portfolio,
including our own.
Every portfolio, and I own some too.
I do too.
And here's what you do. What if we can give you market exposure, upside potential,
with equity-like returns,
a downside, a buffer, which is protection, and a period of time in which you had to hold it,
and in which that protection kicks in?
Yeah. So What I'm saying is we can have S&P 500 exposure, get you some protection. Market goes up, you make money. Market goes down, you'll be protected at some point. So let me just tell you.
All right, again, Goldilocks, this sounds too good to be true.
And let's talk about this. This is the example. This is a fund that we use. It's called a buffered ETF. And I'm going to give you an example of one we just did. It's an April issue. This is hence GAPR. That's April.
And the G stands for?
Goldilocks. Mm-hmm. So with the market, at this point when it was issued, the S&P 500 was 4134. So basically, it's giving you upside from this April, this last month, to next April.
April 2024.
Up to 4740.
Okay.
That would give you 14.67% upside.
I'll take that all day.
And at the same time, give you protection to 3513, a 15% downside protection. That is unbelievable.
So if the S&P between April 1st, let's just say that, I know it's not expirations Friday, but if we were to say from April 1st, 2023 to April 1st, 2024, if the S&P 500 is down 14%, I, as the investor, am down nothing.
And
that's going to help me sleep at night. If everyone else is down 15%, 14%, and I'm down nothing, I have a much easier climb to the positive area than someone who's down 14%.
Okay, so now let's take it a step further. So you have a targeted outcome. You know what your time frame is. This is not a bank. It's not a CD. You don't have bank risk.
They're writing options
on
the S&P 500.
Right. So
there's no bank credit risk involved.
Limited volatility because you have limited downside. You could sell it at any time, understanding that it's got to be for that maturity for the protection to kick in, which we would explain to you. And it's a defined maturity. We know this. We know going in. So what I want to jump to here, because this is what will show you exactly what's going on. Using that, I'm going to use now a 20% buffer because they have those too. So the example I'm using here, blue is the stock market.
From April to April, let's say.
Exactly. Yeah. Orange is what you would lose. Okay, so in this scenario,
with a 20% buffer.
20% buffer, the stock market down 30%, you'd be down 10. In this case, the stock market down 15, you'd be down 0 because it's within that 20% buffer. Now on the upside, stock market up 10, you're up 10. Stock market up 20, you're up 15. Who wouldn't take that?
I'd take it with a smile and gratitude.
Because it doesn't happen very often.
This is offering you equity-like returns with a downside protection, and it helps you sleep at night. And after what bonds did last year, I don't know a single investor who wouldn't jump at the chance.
And bonds were horrible last year, so we know this.
The worst bond market.
And so I want to go and just talk about what we think the Fed's going to do, because there's a meeting next month.
Everybody wants to talk about the Fed.
They want to know that. The Fed is going to meet next month, June 13th and 14th. There is a high probability, there's a 1 out of 4 chance that they will raise rates. So there's a high probability they will not raise rates. But I'm hearing now that they're going to a substitute rate raising. What that means is at the next meeting, they're going to be really, really hawkish, saying, we're not going to raise now, but if you behave badly, we're going to raise going forward. And they're going to scare the market into thinking that they could raise again, but they're really not going to raise again. That's what I saw. It's called the substitute raise, actually. Did you see that by chance?
No.
Yeah.
But with that...
Sounds ridiculous.
No, you know what it sounds like? We're not even thinking about, talking about cutting rates, which is exactly what happened 18 months ago when we were told by the 500 PhDs at the Fed, including the chairman, who said, hey, it's transitory. So it would not surprise me if they did this. What ridiculous term do we call it?
I'm sorry?
Substitute rate? What did you just...
Oh, a substitute rate hike. Yes.
Yeah, okay. Yeah. Transitory. We can all make up words, okay?
And here's the thing, is that I truly...
It's because the market is pricing in 3 different cuts this year that they're like, we got to shock the system. We got to put this little pissant in timeout and give them a real lesson.
I don't think the Fed's going to cut 3 times this year. I don't believe that.
No, but that's what the market is forecasting.
The market
forecasting. The Fed is saying in June we've got to really lay down the hammer.
So let's just show you what the market's forecasting. This is as of May 2nd, so it's been a couple weeks. This is where we are, which is 5 to 5.25 on the Fed funds rate. So the market is forecasting that by January 31st of 24, it will be down to 4.19. So for all intents and purposes, by the way, I did mention that correctly.
Yes, you
all
did.
intents and purposes, we are.
Thank you.
We correct each other on grammar.
I mean, I couldn't care less as long as you're saying it
As long as you say couldn't, I'm okay with that. About caring less, I don't care. But if you could care less,
then why don't you?
Go ahead, care less. But the point is, the Fed, it appears based on this,
is pissed off.
Is going to.
The market thinks that.
Is going to cut rates 0.75-ish% by January 24.
Which, my only response to that is, within 6 months of a rate cut, there's a recession.
Yeah.
So I don't think the market is really thinking about what they're wishing for, and they should be a little bit careful.
That's a great point, because this is a history of rate cuts since 2000. So let's show you here. You're up at over 6% Fed funds. In 2001, they start cutting rates. The gray area is recession. We come down, we trough out. They start raising. They start cutting. Boom, recession. Then we go down because after the financial crisis,
artificially hold it at a 0%.
We're at 0, and now we start coming up a little bit, and then they start cutting again. Recession. Boom. That was, okay.
2018 when they overshot the mark.
Yeah, all right. But then you had the recession in, of course, 2020, which was not an economic, that was a black swan event.
What was it? An exogenous shock.
Exogenous shock to the system. And now, if the Fed cuts rates, look, we know that recession's coming. A recession is coming, folks. It's going to be mild. It's part of the economic system. It's going to be mild.
We don't think it's going to be your 08, your 07 to 09. Let's be honest and be respectful of that recession, because that shit dragged out for a long time. This is not that. People aren't going to be losing their homes. It's not going to be the same. The consumer is in a much better condition than they were back then. We see this as a much shorter recession in the grand scheme of things. On average, they last, 10 months?
They last 10, 12. You could have 13, 14. But I don't think this is going to be... I think it's going to be probably a higher rate cycle. The Fed's not going to be so aggressive on the rate cutting, but they're going to cut some rates. Only... Because there's an equilibrium. I don't know if anybody else out there is a scuba diver. Not that I've done it in a while, but there's something called buoyancy. So... You have a BC. It's a buoyancy control device over your shoulders. Have you heard this story?
I mean, I'm just thinking before Christ, so no, obviously not.
It's the first. Okay, so when you're underwater and you're diving, you hit a control that has your tank goes, and it will buoy you up. So you're not going to hit the coral or any of that. So you can control, and then if you're raising too much, you go. You can let it out or let it in. So I can have a little device that go shh and let it down a little bit. You control your buoyancy. This is exactly what the Fed is going to do. And by the way, it's the first time I've used this analogy. It's freaking awesome, by the way.
So for all of our rom-com fans out there, I just think of Kate Hudson and How to Lose a Guy in 10 Days when she's learning how to ride a motorcycle. She's like, you got to give it a little gas, you got to give it a little go.
Okay. This is way better than that, by the way.
I mean, mine's probably broader.
Okay, so what we're seeing here, these are the leading economic indicators. Usually indicates a recession is on its way. Here is back in the 1970s, the leading economic indicators drop below the zero line, recession. Drop below the zero line, recession in the 80s. In the mid-80s, drop below the zero line, drop below the zero line.
You got the 2001. Yeah. I mean, it's the .com, and then it's also 9/11.
Then it really got sucked out, and then
recession.
Here. But look where we are without a recession being called.
Yeah, right.
And here's why.
The NBER is already thinking about it.
This is why, because the NBER hasn't called a recession yet.
Yeah.
They'll call it.
Committee
they're going to call it 8 months ahead of time.
Yeah.
Which is.
I mean, my rearview mirror is just as good as yours, huh?
That's pretty impressive. That's pretty impressive. My rearview mirror is probably better than yours because
because you got 30 years of experience ahead of me.
No, because the rearview mirror in my car is actually a camera.
Oh, okay.
Okay, so these are an idea of the U.S. leading economic indicators, which is a big deal. GDP, employment figures, industrial production, inflation, of course, is a major issue. Home sales, home building, but it's very interesting when you go and look at this stuff because I know you've done your share of work on it, and it's when the leading economic indicators start tanking, which they really are. I mean, we've been negative economic indicators for a little while now.
Negatives have been positive. This is like this upside down place. I mean, and what's interesting about it is so like those are very broad economic indicators that you're talking about. Within them, you have different things like your purchasing managers index is a great signal as far as where GDP is going.
Okay.
And then you've got durable goods orders, which is, the industrial activity within the durable goods ordering and the stability of your supply chain.
So I guess the whole problem really has been that the Fed is not believing what's going on is because of employment.
It's employment, and we talked about it on the podcast about weekly jobless claims, which is a forward-looking indicator, whereas unemployment is looking backwards.
Yeah, the unemployment figures you get on the first Friday of the month,
right?
That's looking back what happened last month. But we're seeing real time, week to week, and we're seeing some big numbers on the jobless claims.
Ticking up. I mean, last week we had 22,000 more. We had 264,000 people overall claiming first-time unemployment benefits on the 4-week average. That's the highest since January of 2021. That's indicating a softening labor market, which is what the Fed wants. Hence the whole bad news is good news type of situation we're in.
By the way, they get to kick the can down the road.
I mean, so does Congress, and something that is
debt ceiling.
Exactly, that is something that is not as concerning as you would think because the United States defaulting and losing some of our credibility is quite a big deal. But I mean, everyone is thinking that we're gonna eventually get to some kind of an agreement, and then of course we're gonna kick it down to like March of next year.
Yeah. Here's the thing, folks.
Because it's the budget versus the debt ceiling is two different things. Debt ceiling is what we've already spent. We got to pay that.
We got to pay it.
You can't just let yourself default.
Because it ticks up all day long, as you see those little tickers. So here's the thing. We're going to come up with an agreement. Hopefully both sides can agree because this is not a partisan issue.
No.
It has to be bipartisan.
We've already spent the money.
The money's been spent.
So it's not even up for debate.
And they gotta figure out a way to pay it. So the only way they can pay it, they're gonna have to cut some spending. You're not gonna get your Social Security cut. VA, hopefully, benefits will not be cut because I feel strongly about that. I personally would rather pay more in taxes personally than cut VA benefits. Social Security benefits, on the other hand,
why?
I don't know. I just
I feel strongly about our safety social net. I think that if you pay into the system, even if you don't pay into the system, fine. I can't make you do what you need to do or what you should do to be a part of this country that I feel privileged to be a member of. But I'm happy to pay my fair share in order to make sure the vulnerable, aka the people who are 65 and older, in addition to our veterans, the people who fought for our country, get what they are entitled to.
Okay. That was really good.
I know, but you spoke over me, and I'm not appreciative of that.
Okay, well.
Can you imagine if I did that shit to you?
Just play with you.
Yeah.
My point is, here's the thing.
You don't give a shit about veterans.
No, I didn't say veterans.
I
said clearly said veterans. What I said is there are too many people collecting Social Security that did not put into the system.
See, you're upset when I do it to you. It's not nice.
That put into the system. They didn't put it in the system and they get collected.
Correct. But we cannot make systems for people who are going to take advantage of it.
No, we cannot.
Everyone will always take advantage of a system.
So, they do. That's true.
There's no workaround.
So, let's talk about a couple stocks that are really interesting. And we've talked about this because this is one. And I have to tell you that I own it personally. I think, Nick, you own it personally. We own it for some clients, not for everybody. It's not meant for everybody. But this is Norwegian Cruise Lines because it is really, and this is a fundamental play. And you say, wow, why is it fundamental? Okay, well, when you look at where the stock is trading, I wish I had my phone. I do have my phone on me. Okay, So let me go to my calculator because I want to do some math here. And this is a stock that's going to earn the earnings expectation, which is fiscal year end December 31st, is 76 cents. I'm going to tell you where it's trading at multiple PE wise. So it's trading at $14.35.
That's the price.
That's the price. Part of the P/E, it's price divided by earnings. Earnings for this year is 76 cents. So just on this year's earnings, it's trading at an 18 PE or 18 multiple. But the stock market, Nikki, trades
on average trades at 18.
Trades at 18, but stock market looks at things forward. In advance and forward. So when I go to the price of the stock,
the forward PE, or the forward multiple for Norwegian
at $14.35, and I'm going to go with the estimate of $1 divided by $1.56.
Perfect.
That is a 9 multiple for this stock.
Cheap.
I would be all day long, and I did. And if you can assume single stock risk and something that's very, very volatile, but look, it's in a downtrend. It's going to get above that. Love it.
It's also within the travel and leisure sector. And how much of a stocks move is responsible for the sector that it's in?
Nikki, and they're all saying we are pre-pandemic levels and better as far as bookings. That's unbelievable.
No, but what would you say? It's like 80% of a stock's move has to do with the sector that it's in, right?
And the sector's great.
So?
We're seeing that across the board with leisure, but the cruise industry hasn't got it yet. And let's take a look at the other stocks within that industry, because that's always, we look at that. So we'll say, we like this stock, what else is in there? So let's take a look at, let's look at Carnival, which we own some Carnival in the portfolio. And Carnival is already in that process of bottoming out. Look at this. I mean, it's formed that bottom, cleared it, volume taken it. I mean, their multiple is not going to be as good, but again, they also were performing worse. Let's go to Royal Caribbean, which has been actually the best performer out of all of them. Look at the differences.
Yeah,
this is Royal Caribbean. It just broke out again after a long uptrend from July of last year. It's been an uptrend. So let's look at them one right after each other. Royal Caribbean.
It didn't get the C.
Oh, sorry. Carnival. And now, there you go. So they're a little bit behind. Both Carnival and Norwegian are a little bit behind Royal Caribbean. So I think they're all going that direction.
I agree. And hey, I mean, I don't know about Royal Caribbean, but I know at least with Norwegian and Carnival Cruise Line, if you own, 200 shares, you get a discount on board?
I think you only need 100 shaars.
100 shares?
Yeah.
I mean, hey.
So
if you plan on cruising in the next year on either of those two lines?
I've actually called clients and saying, hey, are you taking a cruise in the next year or so? If they are, is it Norwegian? Well, maybe, maybe not. I said, well, if you want to own Norwegian, I could buy you 100 shares for literally $1,400.
And I think you get like a $3,000 on the cruise ship kind of.
No, what you do is that but you own the stock you're going to make money on. You get $250 on board credit.
On board credit. I mean, hey.
So that is a great deal. So right there, what that does, it gives you a $250 on 100 shares. It gives you a 20%, 15% protection.
Okay. Right
there. So those are things we're looking at, folks. We look at other things. The buffered ETFs are always great. Give us a call, 407-831-8002. Again, I'm Lee Seiler, also known as the StockDr.
I'm Nikki.
Nikki, are you negative Nick today?
No, Nikki Numbers today.
Nikki what?
Nikki Numbers.
Nikki Numbers. Nikki Numbers. But we'll see you next time. Thank you very much. Check us out. Please share this. Share this, everybody. We'll see you next time. Thank you.